coming up on Retiring Well with Michael Reese.
Protect the asset. In other words, protect the money in the endowment. 2, distribute income periodically. And 3, they want to grow the value. Why aren't you doing what they're doing, right? Why aren't you kind of patterning or modeling your portfolio after what they do?
Most of them have better than half their assets in alternative investments, which goes against everything most people are in, right? We're all in stocks and bonds and mutual funds, and here these endowment funds are all over here in what you call alternative investment.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese. We've got a great show lined up for you this week. We are talking about, you ready? Asset allocation. Woohoo! That's very exciting, isn't it? Asset allocation. Blech. That's not really what we're talking about. What we're really going to talk about is diversification and what does it mean to be effectively diversified? I mean, think about it for a minute. Isn't that a word you hear all the time is you want to be diversified. You don't want to put all your eggs in one basket. You want to have a great asset allocation plan. Haven't you heard those phrases before? I mean, of course you do, because we in the financial world feel real smart when we tell you stuff like that. But here's the question. Let's take a step back for a minute, okay? Why do you want to be diversified? How does that benefit you? What does that really mean to you to be diversified? What's the value here? Well, really the reason is this. As you think about your retirement planning, you're probably sitting there, if you're like most people, and you're saying, well, I want to be diversified because I want to spread my risk. Maybe that's what you want to do, spread the risk. Okay, great. You want to spread the risk. What exactly does that mean? Well, if you want to spread the risk, the reason is so that if markets go bad, you don't lose as much money, right? You don't lose as much money when times are bad. Bingo. That's exactly the point I want to get to. The goal of diversification is so you don't lose as much money when times are bad. That's why people do it. But of course, that begs the question, are you doing that effectively? Are you doing it the right way? And that's really important. So, behind me on the screen, you see what we affectionately call in our industry the Skittles chart, right? We call it a Skittles chart because, look, it's a rainbow of colors there, right? And each color represents an asset class. Now, have you ever talked to your financial advisor and they show you this Skittles chart and they say, look, we need to build an asset allocation because, look, if you look at any one color, it's never the best place to be. Sometimes large companies are the best place to be, sometimes small companies, sometimes it's real estate, etc. But because we don't know which color is going to be the best place to be for the year, what we need to do is build an asset allocation model where we hold a bunch of these things. You ever heard a financial advisor tell you that? That's great. That's true. And you know what? Doesn't that feel good? Doesn't that feel comfortable? And so they build you this portfolio, and in a typical scenario, in a classic balanced approach, you've got about 60% of your money in the stocks on the Skittles chart, and about 40% of your money in fixed income on the Skittles chart, and everything feels good until like 2008 comes along, and you still lose 30 to 35, about a third of your money. How does it feel to be diversified, but still lose a third of your money? Is that diversification? I mean, are you diversified if you lose a third of your money? I don't think so, right? You're not diversified when you lose a third of your money. So the Skittles chart is a great way to help you make you feel comfortable, make you feel confident that you're making smart choices. But the whole problem with it is, it's, how do I best say this on public television? It's not true. There, I'll just say it that way. It's a bunch of BS. It's simply a way to sell you something. The reality is this: if you look at big money, you look at the big institutions, do you think they use a Skittles chart to put together their portfolios? Heck no. They do a much higher level of diversification because they have to be effective. They can't be losing a third of their money just because the markets don't cooperate. And here's the deal: you can too. You, in today's world, with technology where we're at today, you too can be truly, effectively diversified. You too can create an asset allocation model, if you will, like an institution, where if the markets go south, you're not losing a third of your money. And folks, the secret behind that is why you want to stay tuned in. That's what we're going to talk about today. Don't go anywhere. We'll be right back.
The new Trump tax code opens the window to potentially saving thousands on your IRA. Learn how to take advantage of the new law at a dinner evening with your Retiring Well TV hosts from Centennial Wealth Advisory. This is a no-cost, information-only, no-pressure event with a fine dining experience you won't soon forget. Important topics we'll discuss are 3 ways to use the new tax code to move money into tax-free accounts at reduced rates, hidden tax-related pitfalls that most advisors are missing, the importance of managing risk, and the effect of volatility on your retirement savings. The #1 mistake most Americans are making with their retirement accounts. Are you one of them? And much more. Dinner is on us, and there is absolutely no obligation. Call 888-608-5825 to register and choose the date and location that is most convenient for you. Tuesday, June 12th, or Thursday, June 14th at Boone's Long Lake Inn in Traverse City, or Tuesday, June 19th at the Otsego Club and Resort in Gaylord. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. Don't miss this important presentation and learn how the new tax code opens the window to potentially saving thousands. Call 888-608-5825 today.
Hi, I'm sitting here with Larry Flynn. Thanks for being here, Larry.
Thank you, Mike.
He's one of the advisors at Centennial Wealth Advisory. And folks, as you may know by now, we certainly invite you to come visit with us. It's absolutely free to get a second opinion on your retirement planning. And I think it's important to get a second opinion from someone who's a specialist when it comes to retirement planning. And Larry, I'm sure they're wondering, if they pick up the phone and they call and come visit with you, what can they expect? What's that experience like?
Well, Mike, they can expect not to get hard sold, okay? We're gonna greet them warmly. We're gonna sit down and talk to them a little bit about maybe their story, where they're from, where they grew up, how they met their spouse, what they're dreaming of doing once they get soon to be retired or retired.
Kind of what are their goals, right?
Yeah, what are your goals? We're gonna talk to them a little bit about who we are, what we do, show them how we do things, especially dealing in the market realities we find ourselves in today.
Got it. So essentially, they're coming in, you're learning a little bit about what's important to them, what their goals are, what they're trying to accomplish. I'm sure you're taking a look at what they're doing so far. You maybe share a little bit about you, and it's just in a very relaxed atmosphere.
That's right.
And there's no cost to do this. Is that correct?
No cost. No cost.
All right. So, folks, there you go. I mean, it sounds very simple, very easy, very laid back. There's no reason for you not to just pick up the phone, call the number on the screen, come visit us, get that second opinion. You'd be glad that you did. This week in Chalk Talk, we're going to discuss how the big institutions and the endowment funds, how they manage money. And this is important because we're talking about effective diversification this week, and we're talking about how, look, these guys can't go about losing 30% in a single year, so why should you? Now, what is an endowment, by the way? An endowment might be like the Harvard endowment or the Yale endowment or a big hospital endowment, where essentially their goals when they invest money is pretty simple. It's right up here. Here you go. Ready? Here they are. 1, protect the asset. In other words, protect the money in the endowment. 2, distribute income periodically. And 3, they want to grow the value of the endowment. So, in other words, protect what you've got, take some money out, and grow it if you can. What does that sound like to you? Doesn't that sound a lot like what you want to do with your retirement? I mean, isn't that what retirement planning's all about? Protect your nest egg, take some income, and if you can, grow it a little bit. Well, endowments are doing the same thing, and they're the best in the world at doing it. So the endowments, the big institutions, those are their goals. All right, so here we go. Recent study, they went across all these different endowments and all these different institutions, and they said, all right, tell me where you have your money allocated. What kind of assets? What does your asset allocation look like? Well, here you go. Here's the answer. This is where they were. U.S. stocks. These endowments had about 16% of their money in U.S. stocks. They had 9% of their money in fixed income. That's it, 9. 19% of their money in international stocks. So right away, what are we seeing here? Already, they have more in international positions than they do in U.S. positions, which I think is kind of interesting, right? But I know what you're doing at home, right? You're a math person probably. You're saying, well, wait a minute, Mike. Wait a minute, I don't get it. 16 and 9, that's 25, and that's only, gosh, it's only like 40-some percent, right? 44% or something like that. Where's the other half? That's only half the money. Where do they have the other half of the money? It's a great question. Here's where they put essentially half of the portfolio goes into this word right here, alternatives. Alternatives. Typically they've got something like, maybe 52% of their money there, the other 3%'s in other, the other category, or the other 4%, whatever it is. 52% of their money, though, is in alternatives. 52%. Half their money is in alternatives. Alternatives, real estate, gold, commodities, private equity, hedge funds, stuff like that. Now, holy cow, that's not just a wow, that's wow. That's a big chunk. 52%. So, when I look at this, I don't know about you, but here's what I'm thinking up in my head. I'm thinking, all right, let's take a step back here for a minute. Their goal, now these people, they've got big time money. You got the best in the world running this money. Big time money. They're saying, all right, here's what we're trying to do. We have this endowment, which is a fancy word for a big pile of cash, right? They got a big pile of cash. Said, we want to protect that pile of cash. We want to distribute a certain percentage out each and every year. And if possible, while protecting and distributing, at the same time, we still want to grow the big pile of cash. That's what an endowment does. And the very best in the world who are trying to do this say, about half the money should be somewhere down here. And the other half looks like that. Right. So my question is, what does your allocations look like in comparison to this? If that's your goal too, just like an endowment, and endowments are the best at managing money, and this is how they do it, why wouldn't your allocations look somewhat similar? That might be a question I'd want to ask my financial advisor. And if you're doing it on yourself, if you're doing it on your own, might be a question you ask yourself when you look at yourself in the mirror, right?
NMC Extended Education is introducing an educational class titled Retirement Secrets, Your Best Is Yet to Come. Our very own Larry Flynn will be the presenter. If you are nearing retirement or already retired, then this class is for you. Many things can threaten your ability to outlive your assets and retire well. The three big things being healthcare, inflation, and taxes. Learn to navigate the critical issues that a retiree must deal with. You'll learn how to plan for a predictable and sustainable income, minimize taxes on your IRAs, maximize your Social Security benefits, and avoid estate planning mistakes. We'll also discuss long-term care concerns and what investments are appropriate in different situations. The cost is only $69. Materials will be provided, and a spouse or guest may attend for free. The class will be held on 2 Wednesday evenings at 6 p.m. for 3 hours, June 13th and June 20th at the NMC Great Lakes campus. Reserve your seats today by calling NMC at 231-995-1700. The class is called Retirement Secrets. Again, that number is 231-995-1700.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Welcome back. In our last segment during Chalk Talk, we discussed endowment funds and institutions and how they have goals: protect the principal, distribute income, and grow the whole asset, that are, quite frankly, about the same as your goals during retirement. And so we learned about how they like to utilize alternatives in a serious way in order to make all of that happen. So now the question is, okay, well, wait a minute. What are alternatives? What are these things that they use? And go into some more depth. And quite frankly, how do you get those alternatives in your portfolio? And gosh darn it, why hasn't your advisor talked to you about it already? If you will. So let's go ahead and hit our list again of alternatives. And this is not designed to be an exhaustive list of alternatives, but here are some of the things that you should be thinking about having as part of your portfolio. So we all know about real estate and gold. Those are a couple of the big ones. But here's some others. What about things like natural resources or other commodities? What about private equity? What about things like billboards and cell phone towers? Mezzanine financing might be another one. And oh, by the way, annuities can actually be an alternative. So there's a lot of different alternatives out there. I mean, imagine, what are hedge funds investing in? These days, all the big news is about Bitcoin, right? That's an alternative, but gosh darn it, do you really want Bitcoin as part of your portfolio? I don't know about that when it comes to retirement. In any event, my point is these endowment funds, these big institutions, they're using alternatives like crazy. So my question is, if your goals are the same as their goals, and they're the best at managing money to make those goals happen, why aren't you doing what they're doing, right? Why aren't you kind of patterning or modeling your portfolio after what they do? Now, they might use half their money in alternatives. That doesn't mean you need half in alternatives. Maybe it's not a bad idea. But my point is simply this. Why, if that's how they do it and they're better at doing it than anybody else, why aren't you doing something similar? And is your advisor helping structure you so that you're doing something similar? Are they already talking to you about these things? Not in a little way, but in a serious way. Right? So how do you do this? What are some things that your advisor might be talking to you about that could help you get a portion of your money in these types of alternatives? Well, remember in the old days when mutual funds first came out? Why did mutual funds come out? Do you know why mutual funds came out? Because back in the 20s and 30s and 40s, way back then, people wanted to invest in stocks, but in those days, if you wanted to build a diversified stock portfolio, you needed to be a pretty wealthy person already. you already had to have money. And it was really hard for any individual just to start to build a diversified portfolio. So along comes the idea of mutual funds. They say, no problem, here's what we'll do. We'll take some of your money and some of your neighbor's money and some of the person across the street's money, and we'll pool it all together. And that way, we'll have enough money that we can go ahead and build that diversified portfolio on your behalf. That was the idea behind a mutual fund to begin with. Well, guess what? The problem with alternatives, it's the same thing today that the problem was back then. To really do alternatives effectively, you got to have a ton of money. You already got to be rich. And rich, by the way, we're talking 10, 20, $50 million rich, not, oh, I got $1 million rich. So what's happening? Mutual funds might help to do that. Exchange traded funds might do the same thing, but the same idea, pulling a bunch of people's money together in order to gain access to that asset class. Limited partnerships might provide something along those lines. So there's a lot of ways today that you can gain access to these tools that traditionally have been only for the really, really rich or the big institutions and endowment funds. So here's my question. To what degree has your advisor been talking to you about this? Is it your job to bring it to their attention, or is it their job to bring it to your attention? The point is, we always talk about getting a second opinion. Maybe this is the reason that you should take advantage of that and get a second opinion on your retirement planning.
The new Trump tax code opens the window to potentially saving thousands on your IRA. Learn how to take advantage of the new law at a dinner evening with your Retiring Well TV hosts from Centennial Wealth Advisory. This is a no-cost, information-only, no-pressure event with a fine dining experience you won't soon forget. Important topics we'll discuss are 3 ways to use the new tax code to move money into tax-free accounts at reduced rates, hidden tax-related pitfalls that most advisors are missing, the importance of managing risk and the effect of volatility on your retirement savings, the #1 mistake most Americans are making with their retirement accounts. Are you one of them? And much more. Dinner is on us, and there is absolutely no obligation. Call 888-608-5825 to register and choose the date and location that is most convenient for you. Tuesday, June 12th, or Thursday, June 14th at Boone's Long Lake Inn in Traverse City, or Tuesday, June 19th at the Otsego Club and Resort in Gaylord. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. Don't miss this important presentation and learn how the new tax code opens the window to potentially saving thousands. Call 888-608-5825 today.
Thanks for joining us today on Retiring Well. My name is Art Canfield, and this is Larry Finn with me today. And we're going to be talking about alternative investments today, Larry. So obviously it's something that you probably have heard about maybe over the years or something like that, but we're going to talk more about what it actually is, how it can be used, and maybe is it something for you?
It's funny, Art, because alternate investments, for the most part, was only available to what you would call accredited investors. Now, I know our viewers are trying to figure out what is an accredited investor. Well, it had to be somebody that typically had over $1 million, of net worth, or maybe had over $200,000 per year in income. Okay, so those were typically the only people that could even look at an alternate investment, right? Now, many ask, well, what is an alternate investment? Really, it's basically anything that's not a security, right? They can't trade on the New York Stock Exchange, for example. Now, I think the exception to that would be real estate investment trusts. Some of those are public. But for the most part, there are things like cell phone tower leases, right? They're collateralized art. They're basically anything that can produce a good amount of income, but it's not necessarily a security, right? Now, we talked about in the show about endowment funds. Right? Most hospitals and universities have these endowment funds, and they're basically big pots of money that are there to pay for their future operating expenditures or maybe capital expenditures, right? And you got to understand these endowment funds want to preserve this, right? They can't afford to lose half of it in a year because that affects their operations, right? So what do they want? They want to protect it and basically produce an income. Doesn't that sound real familiar?
Most people would be pretty happy with that, right?
Well, most people we're dealing with, right, that are getting soon to be retired or retired, that's exactly what they want, right? Hey, protect this now because I'm getting ready to be unemployed for 20, 30 years. You know, protect this, but guess what? I need to have it become an income for me, right? Well, that's what these endowment funds are. But Mike shared a statistic that quite honestly is a surprise to me that took 800 of these endowment funds, and on average, most of them had better than half their assets in alternative investments. Wow. Which goes against everything most people are in, right? We're all in stocks and bonds and mutual funds, and here these endowment funds are all over here in what you call alternative investments.
Sure. So the indices that everybody pays attention to, the Dow, the S&P, that we're seeing go up and down on a daily basis, these people have less than 50%, basically, is what you're saying, invested in those means.
That's right.
Wow.
That's right.
Yeah.
Well, and most of these endowment funds too, or when you get involved in these alternate investments, they tend to have they don't tend to have the same risk as the market, because the income streams that they're generating are usually a little bit more stable. Like, for example, a cell phone tower lease, right? Well, the market, you can have an '08, but people are still going to have their cell phones, right? Those towers are still going to be producing an income on a pretty regular basis. So they tend to be traditionally a little bit more stable.
Gotcha. And there's probably different factors that relate to that, just like with everything else. One thing that I want to circle back around, because I think it was very interesting, you talked about at the beginning with the accredited investors with alternatives. Now there's some different avenues now, right, that people can so choose. If somebody's sitting there saying, well, I don't have $1 million, I don't make $200,000 a year, but I may be interested in this because it sounds like it's interesting to me, but so how people can do that now, right, that may not meet those?
Well, go back to the 1920s, right? The average Joe could not get involved in stocks, right? And if they could, they had to have quite a bit of money, and then they couldn't really even get very diversified, right? Because they could only maybe get into one or two. Now, so what came along back then? Mutual funds, right? Mutual funds came along and said, okay, we're going to take this big pot of money, we're going to go and buy all those stocks, and then you as a shareholder of that mutual fund can share in it pro rata, right? So it allowed the common Joe to be able to get into mutual funds. Today, mutual funds are being used as a tool to go out and get these alternative investments. You no longer have to be that accredited investor, so you can get this asset class into the mix. But it's just quite interesting now, the tools we have available to be able to do that. But anyway, thank you for joining us today. We appreciate it. If any of this is of any interest to you and want to talk more about it, myself or Art would be glad to meet with you. So give us a call.